Hey, welcome back to Holdco Builders, where we learn how to buy good businesses, how to run them well, and how to compound them for a long time. And today we are talking about search funds, the operator first way to acquire a small business. And we're going to do it through the lessons of Tim Ludwig. And Tim has a fascinating track record. He has invested in 60 plus operating companies. He actually discovered search funds while studying in business school. And after making those 60 investments in operating companies, he then flipped to become a buyer himself, went down to market, very disciplined approach, and looked for 1 to 2 million EBITDA companies. And now, today, he co-runs Majority Search. It's a single LP model with committed capital that can close deals without bank debt. So if you're in your 20s, if you're in your 30s, maybe even 40s, and you're thinking of, can I actually buy a business? I think this episode is your map, because during this last weekend, I took maybe close to 14, 15 hours to put these materials together. I was listening to Tim's different podcast shows. He's been active on Twitter, many tweets, and I just really wanted to put together like one source where you can cover how search fund works, what kind of businesses one should actually buy, where they have the highest chance of winning, the profile of a great first-time CEO, how to run the search, how to close deals, and going even more specific, what one should do in the first 100 days so one doesn't break payroll literally, and why most wins are singles and doubles that compound into big outcomes. So let's start with the background of Tim and why we should study him and why this model, this search fund model, is so lucrative. So it all started in a business school in late 1990s, dot-com area, and Tim already knew that he didn't want to go down to this Fortune 500 path. And he was literally like sitting and walking around in a library hunting for off the beaten path ideas where he could do something different. And he stumbled on an early Harvard case about search fund. And he had this, as he said, light bulb moment. Wait, people will back a young operator to go find and run a small business. And this was fascinating. Now it's more common, obviously, but back then, take 15, 20 years ago, it was like a magic. So he decided to read and go through this Harvard review research. And then in order to learn more, he writes Harvard for more cases and traces to the roots to Irv Krauschek, who's one of the originators. I hope I pronounce it in a correct way. So he wanted to read more, study more, and he did this independent study predicting that search funds would professionalize over time, which eventually happened. I mean, doing this episode, it's 2025, and people know about search funds, let's put it in this way. But then he didn't start immediately. He went to work for different startups, founded few, and he even worked in a real estate for 6 years. And this allowed him to pay off loans. And by that time, he had a small nest egg. And he almost did a self-funded search himself. But they moved with his now wife to, I think it was somewhere in California. So it was like a narrow area where they didn't want to move. So he had to start looking for local businesses, and he couldn't find anything, if I'm correct. So instead of buying one himself, he tried backing searchers. And this happened in, again, 2007. So it was perfect time for this type of model, because big firm didn't chase MBA students and MBA people that much. The hiring pretty much freezes. So suddenly the 2-year search looked extremely attractive. You either become a CEO if it works, or you can just tell a great story like I sourced deals for 2 years in case it doesn't happen. So Tim raised a tiny first fund. A lot of his was his own savings. Leaned in as a very active investor. I mean, like weekly calls, diligence seminars, stuff that's very normal now, but no one did it back then. And to sum up this period, it was like a decade in Tim's life. It was all inbound deal flow, which came to him. And that led him to make those 60 plus investments. So today he has this portfolio of 60 plus operating companies. Then 10 years went by, the space got crowded, deal sizes and purchase multiples went a bit too high, and the portfolio didn't do that well anymore. He has even said that it got harder to mentor deeply. And he felt like he should do something else. So 5 years ago, he flipped, turned off traditional search investing, and became a buyer himself. Again, as I mentioned in the beginning of this research, he went down market at 1 to 2 million EBITDA companies, where prices were better. He founded one company with a partner, bought 2 more, installed management, and he really, once all this was done, he described this that he really loved the control and alignment. And then on Twitter, he saw like this massive wave of self-funded searchers using SBA, which is like a 7-year loans, government-backed small business loans that usually require a personal guarantee. He tried to design an investment platform around that, but the rules were too constraining. At that same time, like sometimes you are in this position that you really want to do something, but maybe don't have enough courage to do it yourself. But at that time, a gentleman called Justin Purris, who's ex-merchant banking guy, sent a DM to Tim. They clicked on a model between traditional and self-funded search. They launched Majority Search, which is a single LP, I mean like one capital source, committed capital, and they have this ability to over equitize, I mean closing a deal without bank debt, while all targeting that same 1 to 2 million EBITDA pocket. And so far, they've onboarded searchers who tend to be older with real P&L leadership, and maybe not just those fresh MBAs right out of the university school. So that's exactly what they're doing today, but I want to get more in depth to explain like what is a search fund in plain English. And think of search fund as a mini leverage buyout where the operator comes first. And there are 3 main flavors. Number 1, traditional search, where you raise a small like search budget to pay yourself for 2 years. And Tim said his benchmark is 125K a year plus expenses. You run a full-time deal search. When you find the company, you go back to your investors to raise the acquisition equity. And targets are usually 2 million EBITDA businesses. And it's going to be like a CEO ownership, typically up to 25% when doing it solo, or 30% when having a 2-person team. And after investors get their money plus a preferred return, it vests in thirds: 1 net close, 2 over time, and 3 based on performance, often IRR hurdles. And then we have self-funded search, no paid search budget. You search while working or living off savings. You typically use SBA, this 7-year debt, and often up to 5 million with a personal guarantee. And the crazy thing is that if the business fails, you're personally on the hook. So targets are often around 1 million EBITDA businesses because of the debt cap. And the debt can be 80 to 90% of the purchase price, and you usually end up with more ownership than the traditional path, but with more personal risk. And the Tim's model, the majority search, it's a single LP with committed capital, and they can over equitize, buy the company entirely with equity, so there is no bank financing to spook sellers. And the target sit between 1 to 2 million EBITDA companies, and the CEO equity is 100% performance based on EBITDA growth over the first 5 years. The translation is that if you grow fast, you can own a lot. If outcomes are so-called normal, it nets out similar to traditional search. And if you don't perform at all, you get way less. So upside for hustle. Quick break. If you want more inbound deal flow and at the same time you're tired of chasing deals in 10 different places, then today's sponsor Capital Bad would be a great place for you to start, because they turn your pipeline into inbound. Take one dashboard, all the information from company profiles, financials, notes, all the updates, everything you need to know to make your next investment decision investing in a profitable company. So instead of pitching cold, get founders and brokers coming to you with a complete context, so you can just simply say yes or no, and you can do it fast. If you're buying businesses, if you're looking for more deal flow, looking for those great deals to make Capital Bad is your advantage, simply go to capitalbad.com or just hit the link in the show notes and make your next deal come to you with Capital Bad. Again, capitalbad.com. And now back to the show. Search funds work because we match a hungry operator with a resilient business the owner wants to transition. In these days, if you look around Twitter and like overall ETA, entrepreneurship through acquisition and search fund people, they're so lucky because like people have built those massive networks and people are super helpful. When you take like offline, you have Stanford, Harvard, Booth, Kellogg, Wharton, and even the Southeast Conference and Investor CEO Summits. In online, there is Search Funder with 100K members. And in my opinion, the best part is the Twitter, the X, where the common vibe is generosity. Like people share what they learned so other can avoid those landmines. And I would even say it's like this shared DNA, because once you really buy a company and your search is done, you're more than happy to share all the lessons you learned to the next person, because it was hard. You grew a lot as a person, as a business buyer, as an investor, and you want to just simply help others, because in most cases, there were a lot of other people who were helping you when you were on this same journey. So learning straight from Tim is like, what makes a great first-time CEO? Like, yes, everyone assumes you must have this deep industry expertise, but Tim says that data doesn't support that. Search funds have backed many first-time CEOs without prior industry experience and generated strong average returns over decades. And the question, obviously, why? Because we deliberately target businesses that are hard to break. What exactly are they looking for? Growing categories, recurring or reoccurring revenue, high gross margins, ideally 50% or higher is Tim's rule of thumb. Low capital needs, which like strong cash conversion, low customer concentration, and operationally straightforward, not a rocket science, as Tim calls it. Given that, who drives? And Tim has said it's more about EQ than it's IQ. When it comes to EQ over IQ, it's common sense, it's the judgment. You make dozens of small calls daily. If most are sensible, you create a tailwind. Grit, tenacity. You'll get told no hundreds of times. You have to keep dialing. Next is sales and communication. The whole journey is selling. You're selling to investors, sellers, lenders, employees, vendors, customers. Coachability. Don't stomp in as the savior. Listen first. Respect the legacy. Bounded risk appetite. It's entrepreneurial, not reckless. And what are some of the immediate red flags? One thing is arrogance. And Tim said that he has ended interviews in less than 10 minutes when he sensed misfit. And how he assesses? Less tests, more conversations by simply asking uncomfortable questions. Again, uncomfortable but fair questions. And then deep back channel references. He'll even use that thread of reference check during interviews and asking the question, when I talk to your references about this, what will they say? And if you just follow all this, what I just covered here, like what makes the first great time CEO, you'll find those people. And again, coming back, like what type of businesses you should buy and what type of businesses you should not to buy. As I said, buy boxes Tim likes. Industry growth, reoccurring revenue, subscriptions or predictable, repeatable need, 50% or higher gross margins, low capex, low concentration, no single customer will be like 20 to 30% of their revenue. Very important thing he brings out is like honest and reasonable seller. Because if you take like an example, like a local services businesses, HVAC, plumbing, landscaping, all this can work because these are predictable. There is a predictable demand. Like you probably know like how many water heaters will break in your city this year. This is all good, but he also brought out the real gems are those super weird, fragmented niches, things you didn't know existed until you see a company quietly printing cash. And the mindset is very simple. You don't get points for degree of difficulty. Pick easy to run, hard to break businesses. If the seller has grown without a salesperson, maybe simply adding one accelerates growth. And that's really the common sense what many searchers and even search fund investors will miss. And this is your opportunity by simply understanding this and having this common sense. One more quick break. You probably already know that newsletter builds trust, but you don't have time to do the research, you don't have time to write, and you don't have time to ship every week. Spacebar Studios, today's sponsor, does it for you. They do the strategy, interviews, drafts, design, distribution. They do everything. They will be your voice and your schedule and all this in one place where you can turn your expertise into a newsletter that warms leads, educates your market, and compounds credibility without adding a single task to your calendar. So if you don't have time, no problem. Check the link in the show notes and let Spacebar Studios build your trust engine. And if you sign up this month, they'll give you this 2-week free trial. So again, go to spacebarstudios.co or just hit the link in the show notes. Now, back to the show. Next phase is going from the LOI to close and how deals actually happen. I'll cover this part as well. LOI, letter of intent, where you and the seller agree on price and terms and you get the exclusivity. This is typically 45 to 90 days, but Tim says that 60 to 75 is common and what he has seen. And there is different phases. Phase 1, first 30 days, it's company and the market diligence. You validate your few big beliefs. Is that big customer renewal real? Are margins really 55%? Will that key manager stick around? Then pull financials, consider quality of earnings by an accounting firm to screw up numbers. You really have to get smart on customers, churn, backlog, vendor terms, payroll, benefits, lawsuits, insurance, everything like this. Then we have this phase 2, paper the deal. Lawyers draft the asset or stock purchase agreement, employment agreement, etc. Reps and warranties. Seller promises the truth of what they've told you. If it's false, you can claw back via escrow or holdback. And this phase is slower and obviously more expensive. Keep a good relationship with the seller. You'll need goodwill when hard points pop up. Again, having those super hard conversations and going point by point, like discussing it all through. And then, as you said, seller being skin in the game. If the seller rolls equity or carries a seller note, which you can pay back over time, that's more than financing. It's an obvious signal. They know the business best. If they won't leave you any money in, why they are not willing to do that? So it's a great sign if the seller is willing to rolling equity or just providing a seller note. And the obvious reasons why deals die and most common reasons, you learn something big like hidden customer concentration, mistimed revenue, again, quality of earnings reduces EBITDA, and you can't agree on new terms. Might not usually be even a fraud. It's more often about expectations versus reality. Now the super important part, day 1 to day 100, your goal is to just don't break it. And Tim's day 1 rule, make payroll. It's funny until it's not. Blow payroll and your torch trust for months. First 30 to 60 days, don't overpromise. Just listen, just take notes. If it's a still great idea in 90 days, it will keep. One-on-ones with direct reports, small group lunches. Show up, be a human. People are anxious because of this new owner and they have this huge question in their minds. Am I safe? Now, expect different tests. For example, someone may ask for a raise in front of the whole team. You just have to keep your cool and take it offline. And start basic professionalism. timely monthly closes, a simple KPI dashboard, and clear meeting cadence. Like every Monday at 2 p.m. you have this weekly meeting, like things like this. Now, when we take months 3 to 12, hire a real salesperson if they don't have one yet. Put one person in charge of revenue, not the founder doing some sales job, not the part-time marketer, but the true owner, like sets targets, hire reps, runs the process, forecasts, and is accountable for the number. Next goal is like clarify ICP, which is like ideal customer profile. Define exactly who you sell to. Next thing is like clarify pipeline. Make a clean, stage-based sales process with exit criteria for each step. For example, lead, like you have to set up like a CRM, lead, qualified, discovery, demo, proposal, negotiation, closed. And once it's closed, is it won? Is it lost? And for each stage, you want to define like what is the required information, what is the next action step, who's the owner of this, what is the expectations, and all the conversions, aging. And you want to have this CRM and the report volume, like conversion rate, because then you have an overview of what is going on with the sales process. Clarify talk tracks. You want to create like this short, consistent outlines for common conversations. Take it cold outreach, discovery call, demo call, pricing call, and objection handling. Very important. And each talk should track like the opening, 3 to 5 discovery questions, value prop, proof points, suggested next steps. And you have to put it all together, but obviously you want to keep it flexible because people are different. The way people are selling things, the way of communication, it's all different. But you want to have everything as specific as possible. So whoever takes it over in 6 months, in 12 months, you already have something set up because you never know, but you want to have those systems in place. Another thing is that post-acquisition during this period, which I just covered, like 3 to 12 months, the goal should be to map top accounts, top 10 customers, and you should go and meet them because this reduces concentration risk. When you do that, you get to know them, build a bit of trust already. Another thing is that upgrading tools. It's so important because there will be still cases where you see people using this 1998 year Excel, and you should upgrade those, and you should give people proper training. And lastly, building a culture of data-driven decisions and frontline empowerment. If you do all those things, which I just covered, these are like lessons from Tim. He has made those 60 investments, and we can say these things are working. And another thing Tim brought out is pattern to expect is year one margins can dip as you invest in people and systems. But then the coil releases and the growth accelerates on a stronger base in the following years. Now the most fascinating part, returns and how returns actually get made. I'll just give you a simple math. Say you buy at a business at 4x EBITDA with 50% debt and 50% equity. So over 5 years, you pay down the debt from the cash flow, which means that the equity value doubles. And you also grow this business so well that you are able to double the EBITDA, either through sales, ops, or just simple basic things. So at the same 4x multiple, equity value doubles again. That's roughly a 4x equity without any multiple expansion. And if the market later, for example, pays 6x instead of 4x, that can be a bonus. There are no guarantees, but if that happens, it's nice. And now the next question, should you hold? Should you sell? Holding versus selling? Well, if the team's energized and the runway is long, you should hold, because compounding inside one company, having this tax deferred, all this usually beats flipping every 3 to 5 years. And sometimes the CEO hits their personal ceiling or just simply loses interest. That means like a fair time to sell the business. Another important thing to bring out is, should the seller stay when buying the business? Well, it's not necessary in building day-to-day, but a good relationship helps. Being able to text questions for a few months is gold. The bigger value is in their financial alignment. Remember, that's rollover or seller note, because it's a truth serum on how durable the cash flows really are. Again, let me remind you, if the previous owner is willing to roll over equity or seller note, write a seller note, this is a great sign that this is a great business, and you can be sure about the future cash flows. Now, how large is the opportunity? Yes, you can be sure that lots of owners will retire, and at the same time, not every business is saleable, but there are many of those businesses still like too owner dependent, too high of a key man risk, or those businesses are simply too small. But in the range of 5 to 50 million, there are tens of thousands of candidates at any time, and only maybe a few hundred active searches. Now maybe more, maybe 500, even if it's 1,000. As you know, like the cream rises to the top. So if you're super consistent, super disciplined, extremely good at what you do, there's always like great deal flow. And at the same time, important to understand, like not all those businesses, even the super good ones, will never be on the market. So there are a lot of like off-market deals which you hoping to get access to. But again, if you're good at what you do, you're disciplined, you are great at communication, you might have your chance of attracting those deals coming to you. And Tim was asked like this Bezos versus Jeff Bezos versus Elon Musk test, and Tim said something funny. If Bezos and Musk both wanted to run a search fund deal, who would he back? And Tim said he would back Jeff Bezos, and why? Lower beta systems, compounding, calculated bets. That's the so-called search fund spirit. Fewer moonshots, more process, and those singles and doubles that really add up over time. So if you're in your 20s, if you're in your 30s, 40s, and you're super curious, you don't need to be the smartest person in the room. You need to be the most persistent and the best listener, and the one who can simply earn trust. So if this episode helped you, send it to a friend who keeps saying that one day I'll buy a business, because today is the day one. Start by learning the basics of P&L, writing human outreach, or simply joining the rooms where people share their playbooks. And in this day, you should have to share your thoughts on Twitter, or at least read or listen this type of podcast, because I'm sure you'll learn a lot. So once you learn all those lessons and actually doing things, reaching out to people, just go and buy one good company, treat people well, and grow it carefully. My name is Mick. This is Holdco Builders, another solo episode. I hope you enjoyed. If you're first time in here, make sure you comment, make sure you follow, make sure you subscribe, and see you in the next one.